Partners in Ministry, a presentation of Josiah White's Quakerdale Foundation, dedicated to growing ministry support networks, introducing people to a cause that connects with their heart, bringing hope and encouragement to our communities as we seek together to serve as Christ serves.
Welcome to Partners in Ministry. I'm your host, Dan Smith, and today I'll be joined by Lyle Miller. Lyle is a stewardship consultant for Everence Financial. In this interview, we're going to discuss some last-minute reminders on our 2021 tax return, and then we're going to talk a little bit better about how we can be better prepared for 2022. Welcome, Lyle, and thanks for joining me.
Thank you. It's always good to have these conversations.
I'm guessing that most of our listeners have probably already prepared and or filed their 2021 returns. If not, is there anything that we should remind them to be aware of for 2021?
Sure. Yeah, there's actually, there would be a couple of things. The reality is because 2021 is past, there's only a certain number of things that they can actually do yet that still affect for this year's taxes. But there are a couple of things to be reminded of. One of them, obviously, you do have up until April 15th, or in this case, this year, because of how the calendar flows, I think you actually get until the 18th to make contributions to, both traditional and Roth IRAs, et cetera. One of the things to be aware of, however, when completing your tax forms, with the last round of tax reform, the number of people who itemize their deductions on their tax form decreased greatly. But as a part of the CARES Act a couple of years ago, they've added something even for those who don't itemize their deductions, who don't have enough charitable deductions and interest and taxes, et cetera, to itemize their deductions. They can still claim a charitable deduction. And one of the things that's different, a year ago, it was $300 per household. Now it's $300 per individual. So if a household gave up to $600 or $600 or more, they can actually deduct $600 from their income, taxable income this year, even if they didn't actually have enough to itemize their deduction. So that's one thing to be aware of. That is something that's was just approved for 1 year, so it's not a permanent thing, but it is still available in terms of filing your 2021 taxes. If you did that, you would have had to have made the contribution by the end of December of 21. But if you did that, and I'm guessing many of our listeners did, that's certainly something that they would want to include.
Sure. Yeah, I can't remember necessarily, but does Everence actually help out with tax returns or filing returns?
No, we don't have accountants on hand ourselves as far as doing them. Now, obviously, many of us, whether charitable consultants, whether financial consultants, because we're working, so closely with these things, can often give us some guidance. But in all of these things, it's going to be important to talk to the person who is doing your taxes, because we can talk in generalities, but oftentimes, or at least sometimes anyway, there are some, individual nuances for a person's situation.
Sure. Well, for sure, you can begin to advise us, at least from a charitable standpoint. What should we start thinking about for 2022? So let's shift our focus now to the 2022 return. What are some giving strategies that we should be thinking about that could potentially impact our 2022 return?
Sure. Well, one of the things that I'll first say is, that thing that I just talked about, at this point, it is not part of the 2022 tax code. But at the same time, it wouldn't be the first time if Congress changes its mind and extends that. Sometimes those kinds of things happen. So people should, pay attention in case that might happen. But speaking of extending things, that's exactly what happened several years ago with the qualified charitable distribution. That was something that began on a year-by-year basis, and eventually it was a popular enough thing that it became something that they, made as I say permanent as tax regulations ever are, right? But it became an ongoing thing. And basically what that means is if you are a person who's over the age of 70 and a half, and you have a traditional IRA, you can actually make what's called a qualified charitable distribution. And that means it goes directly from, you can request that money goes directly from your traditional IRA to the charity that you want to support. And in this case, it needs to be the end charity. So like a congregation, camp, college, etc. They're not able to use like, the Quakerdale Foundation or Everence Foundation. This one requires that it goes directly to the end charity. And frankly, for people who are over the age of 70 and a half and who have a traditional IRA, I say this is literally the single best giving strategy that's available to them, because it brings their income down, because they don't have to receive these distributions as income and then pay the taxes on them. So it's actually better than receiving it as cash and itemizing your deductions, for example. So if you're over the age of 70 and a half, certainly be looking to that as a possibility. And I will also say a couple of pieces that I'll add in relation to that. For those of us that are under the age of 70 and a half, because that is such a great giving strategy, we ought to be thinking about, or very, very possibly it would make sense for us to be thinking about having a traditional IRA, so that when we reach that magic age of 70 and a half, we can give in that way. A Roth IRA is often great for living expenses, but a traditional IRA can be outstanding for giving expenses. So that's one of the things to be aware of.
Yeah. Can you briefly describe the difference between a traditional versus Roth, if some of our listeners don't know the difference between those two?
Sure. Really, it has to do with when the money is going to be taxed. So in a Roth IRA, you would have paid the taxes, when you made the contribution back in 2000 and whatever, right? But then that means that you can withdraw the money tax-free when it comes out at the, in retirement. The flip side, the traditional IRA is the other way around. You put it in pre-taxed, and so it's not taxed going in, but you would have to pay the tax when it's coming out. So with this qualified charitable distribution, really, you're getting the triple win. You're getting, you're saving taxes when you put the money in. You're not taxed on it as it grows, and then you're not going to be taxed on it as it comes out. I tell people that I'm a big fan of sliced bread, but I think this is really this is even better than sliced bread because of how it can work for our generosity.
Okay, so to kind of summarize the charitable distributions, what's happening here is that I've got a traditional IRA. I've been thinking about, obviously I'm going to use that for income coming down. If the required distribution on that IRA is basically what I would normally give in charitable contributions, I'm much better off using that money for that purpose so that I don't have to pay the taxes that are required under traditional IRA. Is that what you're saying?
Exactly. And
that does not affect in the Roth IRA because I've already paid the taxes on it. So I can decide whatever I want to do. Now, if I go ahead and still make a charitable contribution, is that above and beyond in an additional standard tax deduction still?
Yeah, great question. No, because you have not actually received that as income, you won't receive a receipt for that as a charitable contribution because you never received it, right? So you'll receive an acknowledgement from the organization that you've made that gift, but it won't be considered a charitable contribution. But in all likelihood, you'll still be able to claim the standard deduction, and so so you have that advantage. Yeah.
So the reason the traditional works the way that it does is the fact that the money that's given out of that IRA actually never touches my books. It's just going right from the IRA to the charity, and it's never considered a part of any of my financial activity for that year.
Correct. Okay. And one of the follow-up questions that people often have in that is, they'll say, well, hey, that sounds like my 401k, or that sounds like my 403b, where I, was going to have to pay taxes on that. Can I do this qualified charitable distribution from those accounts? And my response to that is sort of no and yes. No, in that you can't do it directly from the 401k or from the 403b, But you typically can roll those accounts over into an IRA as a non-taxable event, and then be able to make that qualified charitable distribution from the IRA. And so we certainly had many people who have taken they were part of their retirement plan at work, and so they had a 401k, but they sure love this idea of being generous, and so they've rolled that over. We've had a significant number of our financial consultants have helped folks with that process.
Sure. So it sounds like these kind of discussions in terms of how to use my retirement accounts, how to set one up from the very beginning. It really is kind of a good idea to kind of visit with you guys a little bit ahead of time, so that when it needs to kick in, I've already got things in place and I already know what I'm supposed to do, rather than last minute. What do I do?
Exactly. Because it does take a little bit longer than just simply writing a check, for example. So you might have to initiate that process, by the middle of December or something like that, just depending on who's holding the IRA.
Right.
Yeah.
And so then the nice thing about having a partner in Everence Financial is that you guys are going to stay up to speed on everything charitable. That if there's any questions about charitable and its impact on my income, on my taxes, whatever, I can know that you're going to know what's happening in 2022, what's happening in 2020 as it's available, and I can lean on you for advice for that.
Yeah.
Good. So what are some other things? So we talked about the charitable distributions. We talked a little bit about IRAs. What are some other things we need to think about?
Yeah, sure. Well, there's a number of things. One of them, we often describe the kinds of ways that we help people are sort of things that help us now in terms of our taxes, things that help us later, things that pay a stream of income from our taxes. And so that QCD is one of those that helps us now. Another one, tools like donor advised funds have just tremendous amounts of flexibility, whether that's flexibility in terms of the types of assets that we give, whether that's, appreciated stocks, mutual funds, whether it's other kinds of appreciated assets like farmland or rental property, et cetera. Farm commodities, if a person is a farmer, that qualified charitable distribution is a great way of giving. Farm commodities is a great way of giving, and folks could be in touch with us, and we'd be glad to walk them through the nuts and bolts of how that happens. Another way that people often use it is by bunching or bundling their deductions. If you watch TV and you see Flo talking about bundling your insurances, well, we can bundle your tax deductions as well. And so the way that works is, for example, at the end of, using a donor advised fund at the end of 2022, I put enough into my donor advised fund, because we often describe a donor advised fund as sort of being like a charitable checking account. So, and you get the deduction when you put the money into the donor advised fund. So a lot of people say at the end of 2022, they'll put enough into the donor advised fund to fund their giving in future years, to fund their giving for 2023, but they will be able to claim that deduction in 2022. So maybe they alternate between claiming the itemized deduction one year and the standard deduction the next year. So again, that was something that we've had a significant number of people take part in, especially with the last round of tax reform that changed some things there.
Okay.
So that's another one in terms of that.
Yeah. So it sounds to me like the biggest difference between regular giving and giving through a donor advised fund is that in both cases, if I was to give $1,000 to Hope for Healing or to my church, that's immediately tax deductible right there.
Right.
If I give $10,000 to my donor advised fund, I'm getting that $10,000 deduction right away. But then what I'm doing is distributing that $10,000 over either immediately over a period of time from years ahead of time. And the reason that doesn't affect me is because the minute that I give that money to the donor advised fund, it's no longer mine. Is that right? It now belongs to the foundation or whoever's holding that money. My only role is an advisory capacity. Where should it be distributed?
Exactly. And so that also has, some real advantages. I use the idea of just alternating one year and the next or whatever. I mean, it also works really well if someone, for example, sells a piece of property and so has a large capital gains hit in a given year. In addition to the fact that you can also avoid some of that capital gains exposure, the reality is, maybe their income has, substantially increased. Maybe they have a business business, and had a particularly good year, and so the income is going to be really high this year, you can use that to, even fund 2, 3, 4 years worth of giving, with a large gift to a donor advised fund in the given year.
Okay,
Yeah.
great. That's a great tool.
Yeah. Yeah. There are some other, some of the other kinds of tools, charitable gift annuities, charitable remainder trusts. Those are a couple things that maybe even on another conversation, we can, even take a deep dive just specifically into those. But basically, those are both tools that a person can make a gift now, receive a charitable deduction at some level, not the full value, because you're going to be receiving some income back over the course of your lifetime. And there's a lot of flexibility in terms of whether it's 1 life, 2 life, more than 2 lives, et cetera. But then, in addition to receiving this stream of income over the course of your lifetime, then at the point that you pass away, then whatever is left in that gift annuity or that charitable trust goes to support the charity. And so you do have that advantage of an upfront tax deduction. Oftentimes the income along the way is treated, I'll say, favorably in terms of taxes. And what I mean by that is you'll still be taxed on it in all likelihood, but very possibly at a lower rate. And then again, as I said, there's this charitable deduction. I mean, there's this gift that goes to charity at the end of a life. And so that one can be really helpful for a person who maybe wants an immediate charitable deduction and also wants to maybe lock in their income at a given level, or with the charitable gift annuity, for example. Those are great for people who are getting their CDs are coming due and they can renew them at 0 point nothing interest is sort of the what the rates are these days. Well, a gift annuity will often allow people to have that money invested and maybe get a 4, 5, 6, even 8 or 9% return on it, depending on their age, and then be able so a substantially increased stream of income, while also being able to support charity along the at a later point.
Sure. What is the typical buy-in level for a charitable gift annuity or a donor advice one? What are we looking at to get one started?
Yeah. With a charitable gift annuity, they will vary. When folks get a charitable gift annuity through the Everence Foundation, our minimum amount is $10,000. But they can be any amount above that. A donor advised fund will sort of vary depending on who's holding that. Again, with the Everence Foundation, our minimum is to have a $1,000 balance in those, and then there's a lot of flexibility in terms of what how they're invested or whether they're invested, et cetera. And it's going to be on a case by case basis. But those are sort of the starting points: $1,000 for a donor advised fund, $10,000 for a gift annuity. A charitable trust usually requires a larger amount because it requires setting up a trust document, and so we like to have $100,000 for those kinds of gifts.
So it sounds like the trust is probably a tool that basically fits maybe some sort of an estate issue where you inherit a very large amount of money or whatever type of thing. The gift annuity and the donor advice is basically more just kind of from a personal income type of thing.
Exactly.
Are they also? Go ahead.
I was going to say the charitable trust, probably the most common way that they're used in Iowa and states, sort of in the Midwest like this, is often farmland is a great asset because, if it's farmland that has been held, if there's no one in the family that's planning to farm and the farm's, been held by the farmer for a significant amount of time, if they were to sell it, they would have a tremendous capital gains hit. And so that farmland can be a great tool for funding a charitable remainder trust.
Okay, great. Are these tools also, can they be added to as years go by? In other words, if I open it up for 1,000 or 10,000, whatever it may be, I can put some more into it next year or 2 years later or 5 years later, or is it just a one and done type of deal?
Yeah, great question. It depends on which one of those tools. So with a donor advised fund, with a charitable remainder trust, typically, if they're set up correctly anyway, typically you can add to those. With a charitable gift annuity, because it's sort of, it's kind of done as a snapshot in time, that's a one-time thing. Now we do have people who have more than one. When I was pastoring in a congregation, I remember the day when I was sitting at my office and a gentleman came in with the remainder checks to our congregation for 13 different charitable gift annuities that his dad had taken out. And I just kind of imagined, as I knew the father, I just kind of imagined that at the end of each year, he would go into his Everence representative and say, I'd like to get another charitable gift annuity this year, and so he had literally 13 of those set up over a period of time.
It kind of sounds to me like he kind of used those like my parents used to do years ago with savings bonds, where they would buy a bond every year for college funds, and then we turn around and turn those in, down.
Yeah.
It sounds like he was kind of using it that way.
Exactly. Very, very similar, very analogous. Yeah.
Okay. And probably for the same reason, because you couldn't add to it. You always had to buy new ones.
Right.
Whereas a donor advised account or fund and the trust, you could potentially get it set up so that you could make additional donations to those two tools.
Yeah. And I would say in the case of donor advised funds, I think, probably the most people make additional contributions to those, because they are so easy to use, because they have such great flexibility.
Sure.
Yeah.
So let's say that I've had a good conversation with you right after 2021 is done. We started talking a little bit about 2022. We got a few things that are set up. About what time should I be retouching base with you to make sure that everything is still going to kind of function the way I thought it was when I get towards the end of 2022? Give me some timing help here.
Yeah. No, that's great. I mean, in reality, you can sort of have these conversations over the course of the year, right? As you get towards the end of the year, recognize a couple of things. One is that some of these things, to do them, might take a little bit of time. So, for example, if you're gifting stocks or mutual fund shares into a donor advised fund, it might take a little bit of time. So, so you might have to start that process by the 1st of December or the middle of December or something like that. A more complex asset like real estate or et cetera, that's probably going to need to happen earlier. The other piece is to recognize that lots of other people are calling as well. And so it's a busy time of year, right? And so just, from the making it easier for everybody involved, it's, better, check earlier is always better. Right. But things like the donor advised funds, very often, if it's cash going into those can happen very, right up to the very end.
Sure.
But, a great time to, have this conversation is maybe right around the time that you filed your taxes for a given year. You have a snapshot of what that is. You maybe have a sense of how that might, your income might be fluctuating in the next year, and it's fresh on your mind, right? So that's a great time to have the conversation. And then, October, November, even just to sort of, that's a good time when, in essence, sort of doing a tax projection, what you're anticipating happen. That's a conversation that you can have with a financial consultant.
Sure.
And get a sense of, okay, here's some things that we could do.
Sure.
We discovered we got a bonus mid-year that we weren't expecting. And so that's going to create a tax challenge for us or something like that.
Sure. Yeah. I know one of the things we do around our house is every time daylight savings comes, that's our cue to check the batteries on all of our smoke detectors and CO2 detectors. Maybe a Giving Tuesday in November could be an annual date that reminds me, okay, let's just double check with my tax person to make sure everything is in alignment. We're sitting okay for how we thought the plan was going to work out for 2022, something like that.
No, that's a great idea. That would be a great prompt to use.
Well, it sounds like the two main things that I'm getting from this that I would want to make sure our listeners are getting is, one, plan.
Correct.
If you don't plan, you're just totally at the will of whatever the tax law has to be, and most of the time you're going to be too late to do anything significant. So plan early. Second, get somebody that knows what they're doing to help you.
Mm-hmm.
And third, don't forget the incredible power of charitable giving when it comes to a tax plan. That is one thing our country has stayed very, very firm about, is encouraging people to use charitable giving as a way of deferring taxes and doing good work, and actually rewarding you for that. No, those are all exactly right. And it's interesting. Sometimes I've heard the Apostle Paul described as the one of the first fundraisers or one of the first planned givers.
planned giving officers, in 2 Corinthians 8 and 9, he's talking to the Corinthian church, and he says to them, I want each of you to give as you have planned, right? And so even Paul is talking about the appropriateness of planning how we want to be generous to the, in his case, to the church in Jerusalem, but in our case, it's to the church down the road, the local camp, the college that we've been a part of, whatever. That notion of planning is frankly biblical when it comes to our generosity.
That's awesome. Well, I would just encourage our listeners, if you got any questions, call 1-800-Lyle Miller, and then he'll get you all straightened out. So thanks so much, Lyle, for being a part of the call today. I just really appreciate it.
Thank you. Yes, it's always good to be with you. And it's not quite 1-800-Lyle Miller, but it is Lyle.Miller@Everence.com. So, that's a very simple way of remembering it. So thanks again, Dan, for the opportunity to
it's been
share
great
with
to have you.
folks.
Yeah, great to have you. If you do have any questions, Lyle's contact information is right here on the screen. You can also find it in the show notes of this episode. So be sure and give him a call. He would love to serve you that way. He's just got an awesome servant heart. Actually, everybody I've worked with in Everence has been that way. So it's just a great organization. On behalf of Lyle Miller and Partners in Ministry, I want to thank you for joining me today. And until next time, let's get out there and serve as Christ serves.
This has been a presentation of Partners in Ministry, a podcast of Josiah White's Quakerdale Foundation. To learn more and see the show notes for this and other episodes, visit our website. To stay informed of up and coming broadcasts, subscribe to our e-newsletter. To invest in our mission, donate today.